In this video, we are going to discuss about the last memo uploaded by Howard Marks on his website Oaktree Capital. You can find it for free and read it. It's really interesting. And he's answering the question, are we in a bubble market right now or no? Okay, so this memo is about to answer this question. So the first thing that he put and that I highlighted is a global review of the market right now with nice numbers. First thing is the market capitalization of the 7 largest components of the S&P 500 represented 32-33% of the index total capitalization at the end of October. Okay, this is the first thing, which I think it's pretty important, that the market is really concentrated right now. It's double in the last 5 years. Okay. So this is also kind of important. The percentage is roughly double the leaders' shares 5 years ago, which is also an interesting news that it really got faster and faster year after year. And so also, prior to the emergence of the Magnificent Seven, the highest share for the top 7 stock in the last 20 years was roughly 22% in 2000. Okay, so here it's first time seen that we have 33% of the S&P 500 in only 7 stocks. Like, it's something which never happened in the history before, and that is very interesting part. Like, it's like totally uncommon. It's a new thing that have emerged on the market. Also, it's important to note that at the end of November, US stocks represented over 70% of the MSCI World Index, the highest percentage since 1970, according to another Sembalest chart. Okay, Sembalest is Michael Sembalest. I think he's working for JP Morgan Asset Management. So it's interesting to see this, and it shows that right now the US stock market is attracting a lot of money from overseas, from everywhere. Also because United States, they printed a lot of money during the last year, but most of people, instead of using this money to invest in China, to invest in Europe, to invest in Latin America, they prefer to invest this money in United States. They have more faith, they have more confidence on the US market. So same, since 1970, never the US stock was representing 70% of the MSCI World. It's something interesting. Second thing that I highlighted is the 4 elements that show that we could be in a bubble, like that characterize a bubble. The first one is highly irrational exuberance. So this is when people are totally irrational about the market. They start to justify everything for stupid reason, like oh, the market is super high and it will continue to grow because in London it's been 30 days that it didn't rain and it was sunny every day, so the market will continue to rise. Like, they will start giving stupid reason for to justify that the market can go up and will never fall. Okay. The second one is an outright adoration of the subject companies or asset and believe that they can't miss. Okay. If you want to see something funny about this, go on YouTube, go on the history during 2021, before Luna, the crypto Luna crashed, and go to see the YouTubers talking about this crypto. We had so many YouTubers, so many people on the internet, which were like just believing in Luna. They were saying, put all your portfolio only in Luna. It's the best crypto ever. It's a total revolution, blah, 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 blah. Really, go and see those videos now with what happened and what you know what happened after. You see that it was a total adoration of it. It was totally crazy. You had this a lot in cryptocurrency, which is a very emotional market, but you had this also during the .com. Everybody what wasn't investing in the .com company was considered almost stupid. So this is an important, I think, thing, and it's kind of, I'm not saying easy to see, because when you're on the moment, it's always difficult. It's always easy to see the thing afterward and when it happened. But you can have some pretty good sign, I think, with this. Third one, it's a massive fear of being left behind if one fails to participate. The FOMO, fear of missing out. When you start, even yourself, feeling that, damn, I should have invested, I should invest. Maybe tomorrow it will be too late to invest. Like, if you start thinking that tomorrow it will be too late to invest, it's generally not a very good sign, okay? Because even when the stock is great, even if you buy it, I don't know, like even if one day it grows 10%, it can still be a good buy if you buy it on the long run. But when it starts to be speculative and so on, yeah, it can be a problem, and you start to feel that, damn, I need to enter, okay? So take care. If you start feeling FOMOs, it can be a good news, not a good news, but a news that you need to stay away from the market. And fourth one is resulting conviction that for these stocks, there is no price too high, that literally a tree can grow to the sky. And no, a tree cannot grow to the sky. And you will always have, like during the dot-com bubble, everybody was saying, yeah, but it will change totally the world. You don't have any idea how it will go. So we don't really care that the P ratio is above 100, 200, 300. There is no too high valuation for this. Like if you look at Cisco, which was a big leader during this tech bubble, nowadays, still 25 years after, we still didn't have reached the price that it was in 2000. Same for, not same, but for Microsoft, the price reached in 2000, you needed to wait 2016 before starting to make a profit if you have invested on the top in 2016 years without making a profit for a company like Microsoft. So yeah, there is no price too high. It's totally false. Yes, there is some price which are too high. Okay. The third thing that I highlighted, which are I think interesting, is this bubble market by bubble thinking. Okay, perhaps for working purpose, we should say that bubbles and crash are time when extreme events cause people to lose their objectivity and view the world through highly skewed psychology, either to positive or to negative. And this is interesting because we can also have a reverse bubble, let's say in the opposite way, when people are totally fearful, they just say stock market investment is shit and so on. Here it can be also a good opportunity to enter, and as well in the opposite when it's too high, okay. This one is a funny one. Like Legends has it that JP Morgan knew there was a problem when the person shining his shoes started giving him stock tips. Okay, so yeah, if someone which have nothing to do with stock market, which had never been good in finance or anything like this, never invested before and so on, starting bragging about their gains, starting to tell you should do like this, you should do like this, you should see this and this, generally it's time to, okay, there is probably a problem here. Okay. Also you have Mark Twain famously said, like, history doesn't repeat itself but it rhymes. Okay. Here's what we come with generally. Because of this, a bubble arrives after a new technology arises. Dot-com bubble with internet. You also have some bubbles which arrived like with Bitcoin, for example, with the blockchain and so on. You also had, it can arrive when the new technology is not a technology for everybody, but it's a new thing in the financial instrument, a new financial instrument, a new way to value things and so on. This can create a bubble, okay, invariably associated with new developments. Then there is this story that I find quite funny and quite interesting. The explanation often lies in Hans Christian Andersen's story, The Emperor's New Clothes. Conmen sells the emperor an allegedly gorgeous suit of clothes that only intelligent people can see. But in actuality, there is no suit. When the emperor parades around the town naked, the citizens are afraid to say that they don't see a suit, since that wouldn't mark them as unintelligent. This goes on unchecked until a young boy steps out of the crowd and, in his naivety, points out that the emperor has no clothes. Most people would rather go along with a shared delusion that's making investor buckets of money than say something to the contrary and appear to be dummies. Okay? So when a whole market or group of securities is blasting off and a specious idea is making its adherents rich, few people will risk calling out. That's why as well you had so little hedge fund manager, bank and so on during the 2000 bubble, during the dot-com bubble, that didn't invest because everybody wanted to invest. Everybody was like, damn, my stupid neighbor was earning a lot of money thanks to this. He made a lot of cash thanks to this. He could buy a new home thanks to this. And you're not investing me in this. Like, I want to be in. So yeah, that's why like a lot of funds had the pressure to invest in this kind of thing. So it's a pretty good story. It's a funny one. I like it. Here I highlighted like some few rules that he have, and I think it's always important to remember them. It's not what you buy, it's what you pay that counts, okay? A good investing doesn't come from buying good things, but from buying things well. And there is no asset so good that it can't become overpriced and thus dangerous. And there are few assets so bad that they can't get cheap enough to be bargained. I think if you print those 3 sentences, it could help you in your investment every day, especially if you want to beat the market, and especially if you want to be a good investor. Another thing interesting to pay attention to and are very important is when something is on the pedestal of popularity, the risk of a decline is high, because you just need one bad news and it can blow everything off, okay? And it can even be like a little bad news. It doesn't need to be a huge bad news or something like this, but as soon as a bad news can arrive when everything is super highly valued, it can create a big problem for the market, okay? Okay, now talking about NVIDIA, okay, the further good news is that today leaders don't trade at the P ratio investors apply to the Nifty 50. Perhaps the sexiest of the 7 is NVIDIA, the leading designer of chips for artificial intelligence. Its current multiple of future earnings, the forward PE, is in the low 30s, depending on which earning estimate you believe. While double the average post-war PE on the S&P 500, that's cheap compared to the Nifty 50, okay? So 30, yes, historically, like if you take a chart of S&P 500 and of the valuation, the median is 15, 16. Here it's 30. And 30, if you compare to the Nifty 50, it's still cheap because it was 60, 70 before. So yeah, it's, but what does a multiple in 30 imply? First, that investors think NVIDIA will be in business for decades to come. Second, that its profit will grow through those decades. And third, that it won't be supplanted by competitors. In other words, investors are assuming that NVIDIA will demonstrate persistence. Okay, so this is a good example because there is 2 teams in NVIDIA. First team that thinks that they are the most revolutionary ones in semiconductor, and they will not disappear, or at least they will stay on top for years and years because the chips that they have are so much in advance that it will continue like this. And we have other ones that say that maybe the competition can grow up and can create something better even in the future. So in the next 10 years, they will probably not be that good. But things say that now, even companies with really high growth and really high margin and so on, they are still cheaper than what happened during the Nifty 50s or what happened during the dot-com bubble. And they are way better quality business. We're talking about business with a super high margin, growing margin, a 2-digit growth every year and so on, while they are already extremely big. So it's something kind of new for the market. Here is also something interesting. There were only 4 times in the history of the S&P 500 when it returned 20% or more for 2 years in a row, only 4 times, okay? 26% in 2003, 24% in 2005, for the best 2-year stretch since 1997 and 1998, okay? So yeah, those 2 years that we have lived were pretty good. And we don't know what will be next, but we need to know that it only happened 2 times in the history that we had such 2 years in a row with so good result, okay? So here, it shouldn't come as a surprise that the return on an investment is significantly a function of the price paid for it. For that reason, investors clearly shouldn't be indifferent to today's market valuation, and particularly if you are index investor, when you look at the valuation of S&P 500, it's pretty high, okay? Historically, it's pretty high. Even if you look at great company Magnificent 7, it's still a pretty high valuation. So I'm not saying you shouldn't invest, like he's not saying this, he's just saying that you need to take care and you need to be aware of it and to consider it when you will be looking and analyzing your stock, okay? And here is kind of the conclusion and the answer to the question, are we in a market bubble, yes or no? Okay, so the above are the things to worry about, okay, what we saw. Here are some counter arguments, okay? First one, the P ratio of the S&P 500 is high, but not insane, like total. We are not in a totally crazy market today. It's not something that is really, really crazy. Yes, it's high, but it's not insane. I think he described it very well. Second, the Magnificent Seven are incredible company, so their high P ratio could be warranted. Okay, we never seen in history company with such high margin, such little debt, such size and still good growth for the size that they have. It's first time in history. Like almost all of them, they have antitrust issue today. It's because they are so big, because they are everywhere, because they're doing everything. So yeah, it's kind of could be normal that they have a higher PE because they are more reliable and also they have better results than other companies. So why would we value them the same way than other companies if this one are better? So yeah, it could be warranted. Okay. Also, I don't hear people saying that there is no price too high. For now, we don't really have it. Maybe it started a little, but we don't really have it. Okay. And last thing, the market, while high priced and perhaps forcey, don't seem nutty to me, and I agree. And also, if you look at the fear and greed index, now, even if the market is high, we're not in a greed part. We're mostly in the fear part. Every time we have a 1% correction, we are in the fear or extreme fear. So yeah, the market, it's not totally crazy. It's not totally insane. Yes, it's high, but it's not insane. By the way, I will be curious to know your opinion on this. Let me know in the comment section. I will be happy to read and potentially debate on it. Let me know what you think about this Howard Marks memo. I think you should really read it. It's very interesting. And if you don't know, like he have a podcast and you can access for free to all his memo, and it's a very interesting thing to read every time he posts one.